Hello friends, in this lecture we shall discuss multi-option questions relating to principles and practice of banking exam of JAIIB. When a company has to go for a public issue on book building basis, the offer document is in the form of. So whenever the companies have to go for public issue, they go for on the basis of an offer document. In case of book building issue, what is name of that document? Let us see the options. Offer for sale document, prospectus, letter of offer, red herring prospect. And in case of a book building issue, the document, the offer document is called red herring prospect. In a normal issue, it is called prospect. In case of book building, this is known as red herring prospect. Hence, our answer is D option. Red herring prospect is the offer document used by the company in book building issues. In a letter of credit, there is a provision of repeated negotiation of documents subject to payment of previously negotiated documents by the applicant. So such letter of credit is called. So a letter of credit which makes provision for repeated negotiation of documents. Let us see what are our options. Option A, transferable LC. Option B, green clause LC. Option C, red clause LC. Option D, revolving LC. In case of transferable LC, LC can be transferred from one party to another, but negotiation is only once. In green clause LC, there is a provision for warehouse storage of goods. In case of red clause LC, there is a provision for availability of pre-shipment loan to the beneficiary. In case of revolving LC, there is a provision that negotiation can be made again and again, that is on a repeat basis. Hence, our option is D. So in case of revolving LC, there is a provision of repeated negotiation of documents, but it is subject to payment of previous documents by the applicant, and this has to remain within the overall total limit. A forward exchange contract is a contract between the bank and for specified quantity of foreign currency. So what is a forward exchange contract? So it is a contract between bank and whom? Let us see. Bank for sale, bank for purchase, customer for sale, customer for sale or purchase. So a forward exchange contract is a contract between bank and customer, and this contract is for sale or purchase of specified quantity of foreign currency. Hence, D is our answer. So a forward exchange contract is a contract between the bank and customer for sale or purchase of specified quantity of foreign currency. When credit risk arises on account of restrictions imposed by the government of another country, it takes which of the following forms of credit risk? So credit risk has various forms, and when it arises because of restrictions imposed by government of another country, so such credit risk is called direct lending, treasury operations, cross-border exposure, any of the above. And then when restriction is imposed by government of another country, naturally it is in case of cross-border exposures. Hence, when this type of risk arises, It is because of cross-border exposure. Hence our option is, in cross-border exposure, the foreign currency funds may be restricted to be transferred by government of the concerned country, and that may lead to credit risk. In India, banks are required to maintain minimum capital adequacy ratio of. So what is the minimum capital adequacy ratio as per Basel so far India is concerned? 8% as on 31st March every year, 9% as on 31st March every year, 8% on ongoing basis, 9% on ongoing basis. Friends, as per RBI guidelines, in India, banks are required to maintain minimum capital adequacy ratio of 9%, and this should be on ongoing basis, and this is related to risk weighted assets. So for an amount of 100 risk weighted assets, banks are supposed to maintain minimum capital fund of rupees 9, and this they have to maintain on ongoing basis. Hence option D is the correct answer. So the CRAR, capital to risk asset ratio, of 9% is to be maintained in India on ongoing basis and not as on 31st March alone. As per Basel II recommendations, the amount of general provisions and general loans loss reserves should not exceed. So what are the Basel II recommendations relating to amount of general provisions and general loan losses reserves? Let us see the options. 55% of tier 2, 2% of capital fund, 1.25% of risk weighted assets, 55% of risk weighted assets. Friends, the amount of general provisions and loan loss reserves should not exceed 1.25% of risk weighted assets. So this is a requirement of Basel II as implemented by Reserve Bank of India in India. Hence option C is our answer. The amount of general provisions and loss reserves should not exceed 1.25% of risk weighted assets. The Basel Committee on Banking Supervision was constituted by who constituted BCBS, Basel Committee on Banking Supervision? Governor of Central Bank of European countries, governors of Central Bank of Group of 10 countries, governor of Federal Reserve of USA, governor of Federal Reserve of USA, and governor of Bank of England. So let us see the answer. Friend, Basel Committee, it was constituted by governors of Central Bank of G10 countries, group of 10 countries. So our option answer is B. So Basel Committee on Banking Supervision, it was constituted by governors of Central Bank of G10 countries. Well friends, and thank you for watching this video.